Welcome back. Watching Bitcoin this morning, a day after touching a new all-time high, just shy of $112,000, trading in a pretty tight range for several weeks now, despite billions of dollars flowing into Bitcoin exchange-traded funds. Some of the Bitcoin-related names like Block and MicroStrategy also rising over the last month of trading. Coinbase, the biggest beneficiary, up more than 45% in that time frame.
All right, joining us now to talk markets and a lot of other things is former Bridgewater Chief Investment Strategist, Council for Economic Education Chair Rebecca Patterson. Good to have you here.
Good to be here.
In deference to my colleague Sarah, who is not here, but is obsessed with the dollar.
Yes.
Let's start there.
Okay.
I remember you coming on years ago.
Oh, yeah.
As a currency strategist.
Yes.
So what do we make of this over 10% decline year to date on the dollar? Why is it happening, and should we be concerned?
I think there's three main things driving the dollar. One is slightly lower front-end rates, interest rates over this period, because currencies trade on rate differentials. Yep. But I think more importantly, and what's different this time, is that you're seeing both reallocation out of the U.S., both by Americans diversifying and foreigners pulling back slightly. And then third, and really importantly, is hedging. So let's say I'm a large overseas pension fund and I have a tech equity exposure and I want to keep it because I believe in the structural story, but I'm nervous about the dollar, I'm nervous about the Fed's independence. I can hedge out that currency risk. So even if money stays in U.S. equities, which helps explain where we are today, you can still see that dollar weakness.
So as somebody who followed currencies for many years, very focused on them, do we have more weakness to come here? Do the things you just described augur for significant declines?
Yeah, I think so. I mean, we're down about 10% on a trade-weighted basis. It gets us to roughly fair value, but currencies never stop at fair value. They swing between over and undervalued. I think we have more downside, not just because of historical trends, but also because of this allocation shift. You know, people say, well, it hasn't happened yet. We haven't had this run on assets. I'm like, these things take time. You know, if I am, again, a large institutional investor, a sovereign wealth fund, a large pension fund, I have to go to my board and get approval. Then I have to decide how to implement the plan. The whole thing takes several months or quarters. So this isn't going to be a one-off. This is going to be a slow bleed out of the dollar, and I believe slowly out of U.S. Treasuries.
You snuck in Fed independence being a risk there, and I would like to follow up on that. How big a risk is it, in your opinion, given the continued jawboning and the possibility we get a new Fed chair who's very much more aligned with, if not under, the president's thumb?
I think it's a smallish risk in the grand scheme of things. And I say smallish because there isn't a way legally that I'm aware of today for the president to have a majority of the Fed to drive an FOMC decision. Even if he has the chair, even if he has Waller, Bowman, and replaces another Fed governor, Kugler, it's not enough votes to drive it. It's not like the Supreme Court situation. But what we are seeing already is the expectation of less Fed independence is causing a change in Fed funds expectations next year. So you see a kink in those expectations around May, June next year, where suddenly the market expects significantly lower interest rates. You also see it, I think, in slightly higher longer-term inflation expectations. So whether or not the Fed can get his lower short-term interest rate, he's affecting the market.
So you think vigilantes revolt?
Again, I don't think it's going to be a, oh my gosh, Liz Truss moment, escape from U.S. bonds. I think this is rather a slow bleed. Most of the foreign investors who have U.S. Treasuries have them in very short tenor bonds, so 3 years and less. They just have to let them expire and not replace them, right? So let them roll off. So it's not going to be a one and done event, I think, without a trigger. It's just going to be we don't have the demand to meet the supply that's going to be coming, I think, early next year.
Which runs counter to any kind of yield curve control plans that might be in place as well.
Yeah, I mean, the Treasury is looking for things it can do, relaxing the SLR, the regulatory requirements on banks. That could, we don't know for sure, but it could help Treasury demand. The stablecoin issue, which is going to get addressed next week in the House, right? If you have more demand for stablecoins, they have to be backed. They're going to be backed by Treasury bills. So that doesn't help our 10-year and our 30-year yield. It could help bring demand at the short end, but then we just have a steeper yield curve. So the part that hurts America is going to be the long end. It's going to be your mortgage rate. It's going to be your car loan. It's going to be the amount of money you borrow for your business. So that is still, I think, going to be very hard for the Treasury to control.
Finally, just the broader equity markets. I'm curious, valuation. We don't hear about it as often. Are you concerned at all that that's not part of the equation as much as it should be right now?
I mean, at 22 times 12-month forward price earnings, I think you can say stocks are fairly richly valued in the U.S., especially versus peers overseas, even with the performance year to date. Historically, valuations are most useful on a longer-term basis, 5-10 years out. The correlation between performance 1 year out and a PE today is basically zero. But it does add to the matrix you're looking at to say, are stocks expensive? Are they crowded? And I think we are seeing concentration go back up again. We are seeing bullishness, some technical indicators going back up again. And I know the word complacency has become completely overused, but I do think the pain of tariffs is still ahead of us.
You do.
The transshipments from China through other countries has allowed that price not to pass through. Building inventories has helped. But those things are probably not going to continue to the same degree in the months to come. So I still think we're going to see higher inflation and slower growth, significantly slower growth later this year.
All right, Rebecca, thank you.
Great to be with you guys.
Nice to have you here as well, Rebecca Patterson.
Thank you.